welcome to Macros with Mythili, the ET Now show that takes a hard look at major macroeconomic issues and developments in India and overseas. Once in a while, however, we try and look ahead and try and read the tea leaves for our viewers. And that's what we're going to do this week. We're going to look ahead at the monetary policy statement of the RBI due this coming Tuesday. All monetary policy statements are important, but the first statement of a new fiscal has added significance as it lays down the broad philosophy underpinning the RBI strategy for the year and provides some guidance of what we can expect in the months to come. It also spells out the RBI view of the macroeconomy and the bank's own GDP growth estimates. Of course, trying to outguess the governor is always difficult, more so when it's a governor who's on record that surprises can never be ruled out. Nonetheless, in this edition, we're going to try and analyze the macroeconomic backdrop and the possible policy options before the governor as we await his policy statement. In this, I am joined by two experts with years of experience in banking, backed by a sound understanding of economics. I have with me Saugata Bhattacharya, Chief Economist, Axis Bank, and Rupa Rege Nitsure, presently Group Chief Economist, L&T Finance Holdings, and former Chief Economist, Bank of Baroda. Welcome to the show, Saugata, Rupa.
Thank you. Pleasure to be here.
Let me start by asking each of you in turn for your take on the current macroeconomic scenario. How would you describe the state of the economy? More to the point, does the economy need a helping hand from monetary authorities? We'll come to the details of what kind of help later in the program. But for the start, I'd like your response to the question, does the economy really need any push at this juncture? Saugata?
Yes, very nicely framed question. I think you have to start from the global environment because that will have a role in defining India's economic trajectory. As of now, things have quieted down a little bit. There is a sense of a risk on in the environment. I mean, helped by the recent statement by Ms. Janet Yellen that the Fed will be extremely cautious in hiking rates. China seems to have more or less moderated, but having said this, I think there are still very significant risks to the economic environment, the potential for economic volatility coming into India, and we have seen the kind of effects that this kind of potential volatility have. Coming into India, coming in from this, some of the key drivers of economic growth obviously are relatively weak at this point in time, one of them being exports, the other being capex, and the third being agriculture. Agriculture, to my mind, still remains one of the largest risks that we have going forward. If we get good rains, that will provide a significant tailwind to economic growth and economic activity in India. On the other hand, the other prospect of a third successive drought has very troubling implications for overall aggregate demand, for overall growth prospects, etc. Capex is not likely to revive anytime very soon because of the stressed nature of balance sheets of both corporates and the banks which fund corporates. So that remains a potential. Exports are not likely to revive very soon either. So given this, the government's focus on agriculture, reviving agricultural investment, agricultural productivity, I think is very welcome. Together with that, there will be some increase coming in from consumption. But overall, I think we can expect that growth in FY17 is likely to remain moderate, which is probably the way it should be.
Do we need a push from monetary authorities? Can I pin you down to that?
Yes, it is. It has to be a coordinated effort. The fiscal side has already started working. Overall, lower interest rates in an environment where cash flows, interest cover ratios, etc., have been severely impeded. I think a little bit of savings coming in from interest payment sides and the cash flow side, I think definitely adds to the prospects of revival for corporate India.
So, Rupa, do you agree with Saugata entirely, in part, not at all? Do we require a push from monetary authorities at this juncture?
Given that government has done its bit in terms of adhering to fiscal consolidation roadmap, at least on paper, and aggressively reducing interest rates on small saving deposits and giving good amount of push, not just in the budget but throughout FY16 to stress sectors like roads, railways, primarily the infra sectors, and giving good push to agri and rural spending in the union budget. I think if Reserve Bank of India now comes out with aggressive monetary easing measures, it can really support the growth momentum by bringing down the cost of borrowings, because you see that until September, October 2015, we had seen a lot of softening of interest rates, at least in the CP markets and corporate bond markets. But following the RBI's tight liquidity management policy, the trend reversed post October 2015. So I think now, before the uncertainty pertaining to monsoon rains, etc., sets in, this is the last but good opportunity for Reserve Bank of India to undertake aggressive monetary easing. And going by yesterday's Fed's decision, there is a clear hint that the divergence in the monetary policies of different central banks of the globe, that is also getting reduced, and India may also follow suit.
Saugata, Rupa spoke about the need for aggressive monetary easing, and as with all monetary policies, all eyes really on what the governor will do on interest rates, and the issue has shifted to how much rather than the mere fact of reduction. But my question to you is, can a cut in interest rates be the magic wand, or does much more need to be done in the larger ecosystem for a rate cut to deliver? Also, is there any point in the RBI cutting rates and then keeping liquidity so tight as it has been doing for the last so many months? Saugata?
Yes, I think you're absolutely right that firstly, within the space of monetary policy, it's not just a matter of rates. Because remember, the RBI says that, we have done an excellent job, and they have, in keeping the overnight rates and the near-term rates, the 7-day, the 14-day rates, relatively close to the target policy rate. The problem has been the other rates, the 3-month CPs, the 1-year CDs, and all the other, the commercial deposits of banks, etc. All of them have diverged very significantly, part of which is a Q4 phenomenon, as most of us are aware. That's one part. Of course, coming into April with a lot of government spending, with a lot of liquidity coming back into the system, some of these problems will begin to dissipate. Liquidity is going to become a lot better. I think that's the time for the government, for the governor, for the Reserve Bank to come in with deep rate cuts, together with liquidity, to actually force a reduction across the interest rate structure. So that's one. But I don't think, frankly, I wish we get a front-loaded 50 basis point cut. My sense is that that's still probably a little out of the probability. I think we are going to get a 25 basis point cut with an accommodative stance in the policy, dependent on data with the monsoons. Your second question, in terms of, is this a magic wand? Even if we get a 50 basis point cut, is this going to radically transform our view of the economy? Clearly no. But the good news is that, and even before I say this, I think it's probably fair to mention that we are not likely to get a major surge in economic growth impulses in the next 6 months, probably not even the next year. That will take time. But together with the monetary policy cut, I think the government has already embarked, as Rupa mentioned, a lot of steps on the fiscal side, a lot of tax rationalizations and things have been done. I think a lot more needs to be done in terms of rationalizing policy. To be fair to the government, they have already begun to do this. The ability to trade spectrum, say for instance, the ability to transfer mineral rights, a lot of ease of doing business, etc. But I think that's what needs to be deepened, together with the interest rate cut that will provide some cash flow relief to corporates and individuals.
Rupa, you call for an aggressive monetary easing, and Saugata also mentioned that there's very little chance, but it might happen. But the fact is that a rate cut hurts savers, and given the fact that domestic savings, household savings in financial instruments has already come down substantially, if we cut interest rates very sharply, isn't there the risk of domestic savings in financial instruments falling even further? They're already much lower at about 7% of GDP compared to close to 12% a few years ago. So are we walking on thin ice here merely because we're focusing on the borrower's lending rate and not so much on what savers need, and ultimately you do need savings to finance investment?
Mythili, I entirely agree with you. And like I had earlier said on this program, see, Indian financial markets are not as competitive as the markets or the credit segments in advanced economies. So we have many natural barriers to transmission mechanism. Last time also, whatever easing we had seen in the base rates, it was the outcome of moral suasion on the part of Reserve Bank of India. So my suggestion is that Reserve Bank of India should focus more on transmission through CP market or corporate bond market rather than through credit segments. As it is, banking system will be migrating to marginal cost based base rate formula from 1st April onwards. So the banks which have good CASA support and banks which have good mix of fixed rate versus floating rate advances, depending upon their ALM profiles, they can, they will be in a position to pass on the rate reductions in different measure. But there should not be any force element from the side of Reserve Bank of India, because if you look at different ownership groups of banks, even today there is no 100% level playing field, because we all know that state-owned banks cannot charge fees as freely as private sector banks can charge. So their main source of income is net interest income, and we know that their spreads are under stress. But yes, if RBI injects liquidity or aggressively reduces the repo rate, definitely it will be a good signal for financial markets. And like at the beginning of FY16, if we see good rally in money markets and rapid reduction in interest rates, say with on 3 months, 6 months CPs or instruments of smaller duration, that itself will give good support, to many small companies, especially from the SME segment, etc. And as it is, the industrial growth or revival that we are currently seeing is not very broad-based. But wherever there are green shoots, they would receive some support in the form of reduced cost of borrowing from financial markets, if not from credit markets.
While a cut in interest rates is not a panacea, it will certainly help. But it will help only if transmission happens. And for that, the RBI must follow a wiser liquidity infusion policy. But I'm afraid on that note, it's time for us to slip into a very short break, but please do stay with us. We'll be back very soon. Welcome back. You're watching Macros with Mythili, and we are trying to peep into the governor's mind to see what we can expect in the forthcoming monetary policy statement, the first for the coming fiscal, with Rupa and Saugata. Saugata, before the break, we were talking about interest rates, and now let me shift to exchange rate policy. The governor recently made a very strong defense of the RBI's exchange rate policy in a recent speech. Clearly, he doesn't have too many exporter friends, because what is indisputable is that the rupee is overvalued relative to its fundamentals. And while low global demand has impacted exports worldwide, countries like Bangladesh, Vietnam, Thailand have all been able to increase their exports through more imaginative exchange rate policies. So my question to Saugata is, how much should the exchange rate weigh on the governor while framing policy? Or can he assume that a cut in the interest rate will automatically lead the rupee lower?
Well, even before I address this, one small point on the savings versus the investment cost of borrowing. I think it's a difficult question, but the point is that with if you cut rates, maybe that spurs growth. I don't know how that plays out, but maybe growth might have a better trade-off on savings over the course of 2 or 3 years. That's one point to keep in mind. The exchange rate, of course, is yet another very important thing that is also a driver for interest rates in the system. For one, the first point that you made in terms of how much is it that currencies impart competitiveness to exporters. It definitely is in play. I mean, if you see the Bangladesh currency, the taka versus the Indian rupee, I think you will see that the rupee has been remarkably stable, and Bangladesh has been given some additional point. So while not saying that exchange rates have a relatively limited impact, we just don't know how much this is. I have to point out that there are many other factors that impinge on competitiveness for various export segments, etc. in different countries. The state of our ports, the state of logistics, the state of transport, etc. might have a larger segment. But having said that, I think definitely the rupee has to impart a degree of competitiveness. Now, again, there is a trade-off in here. Because given that, as you mentioned, that domestic financial savings have been relatively constrained, we are dependent on foreign savings. And to that extent, for foreign savings, to get more foreign savings in, you need a degree of stability in the currencies, because foreign offshore investors look for currency stability, otherwise that impacts on the total returns of the investments that they make abroad. So that's yet another trade-off that they make. The third point in terms of a rate cut, the effect of a rate cut on debt flows and equity flows, I'm not very sure. I think it depends on the particular state of the business cycle, of the growth cycle of the global financial cycle. But generally my view is that rate cuts are generally good for equity markets, and equity markets, the amount of money that comes in will generally tend to offset whatever little there will be outflows from the debt segment. So I don't think that a rate cut will impinge on the currency. Having said all this, I think we are on a path of a gradually declining currency. It will move with the Chinese yuan, say for instance, and with the dollar strengthening. The trend is definitely towards the currency weakening, which is incentive compatible with exports.
Which is good, of course. Rupa, you know, the rupee has been strengthening in the past few weeks. Is it possible that, going by the RBI's recent actions, is it possible that the RBI is really preparing for the possible outflow from FCNR accounts in September 2015? Because if you remember, in September 2013, the RBI had offered concessional swap deals to banks in a bid to encourage them to get dollar deposits as part of the defense against the dramatic weakening of the rupee following the taper tantrums of mid-2013. So is the RBI deliberately allowing the rupee to become strong to kind of offset the possible weakening that will happen in September this year?
Absolutely, because as Saugata also mentioned, interest rate reductions, they are interpreted differently for different emerging market economies. While for other emerging market economies, that means immediately impacts the inflow of foreign capital. In case of India, interest rate reduction is perceived as a growth supportive measure, and we tend to attract lot of inflows in our equity segments. And that offers a very good opportunity for Reserve Bank of India to purchase dollars aggressively to shore up foreign exchange reserves. And as you rightly said, in the Q3 of FY17, some US dollar 25-30 billion worth of redemption of FCNRB will come into play, and this kind of a rally would not just help India's equity markets or bond markets in terms of giving a good liquidity push, plus also the forex markets, in the sense Reserve Bank of India can make use of this opportunity to shore up the nation's foreign exchange reserves.
Saugata, now let me turn to NPAs. While there is no denying the need to end what the governor had called extend and pretend, has the RBI's insistence on banks cleaning up their balance sheets in a relatively short span of time done more harm than good, with banks turning excessively cautious, as a result of which both credit growth as well as economic growth has suffered? And because of that, can we expect some more concessions in the monetary policy statement to make it easier for banks to comply with capital adequacy requirements without shying away from lending, which is their basic business?
Not that I'm an expert on this area, but I mean that will not prevent me from airing some views. I mean, yes, absolutely, you're right that timely recognition of stressed assets would probably have been needed at one point in time. So this is one point in beginning this, and banks, as usual, normally should make a clear distinction between NPAs, which is banks are in the business of risk taking. So a certain amount of asset stress will develop in the credit process. So that's not the point. But I mean, separating the willful defaulters from the normal course of business cycle stress. So that's one. I think it definitely one of the things that I believe has emerged from this system, from this process of the asset quality review and the consequent actions, is that some accounts, are more stressed from a solvency aspect. From a liquidity aspect rather than from a solvency aspect. So these accounts are potentially still good accounts and can potentially be revived. So I think these, and a focus on ensuring that adequate liquidity flows to these accounts, I think is important. If there is a certain degree of targeted forbearance that comes in the policy to making sure that potentially solvent accounts which are liquidity stressed are given some support, I think that will be very welcome.
Important to know which accounts are solvent and where there's fraud, where there's deliberate refusal to pay, etc. But Rupa, I want to toss a question to you. Sharad Pawar has reportedly written to the Prime Minister today that the RBI's excessive zeal in going after NPAs has really run the risk of stopping banks from lending altogether, and is likely to bring economic growth, is likely to make economic growth flounder. So is that a justifiable criticism of the RBI's policy? Has the RBI been a little unrealistic given the time frame that they've given? There is no disputing their need to ensure that promoters don't default in this way and take public money and take bankers for a ride, misuse public money. But was it a case for doing it more slowly, the time, the pace? Should all that also have been taken into consideration, Rupa?
Yes, absolutely. But we also have to appreciate that there was a certain element of moral hazard also involved there. So as a central monetary authority and banking regulator, it was quite apt on the part of RBI to undertake that cleansing operation and coming down heavily on corporates so as to force them to bring in more of equity support and undertake deleveraging. But RBI itself has realized that aggressive actions at a time when country is suffering from acute deflation and manufacturing slowdown is not helping growth and is making banks more risk averse. So I think they are focusing now equally or more on NPA resolution rather than NPA recognition. But I think the push which RBI has given to asset quality review, yes, it's a bitter medicine, but it was unavoidable. They have done that. But going forward, I feel that they will go about it more slowly, given that macro headwinds have really increased, both from the global arena as well as on domestic front.
Okay, so it was a bitter medicine that had to be administered. But Saugata, before I conclude, one quick question to you. What kind of GDP projection are you expecting for the next fiscal?
Not too spectacular, and not too spectacular. I mean, this year we think it's likely to be about 7.3, 7.2, 7.4. This year meaning FY16. Going into the next year, we are currently we are a little timid in projecting a 7.7% growth. Remember the two risks that come in. One is agriculture. That's something which is relatively exogenous to our entire policy efforts. So if we get good rains this year, I have very little doubt that economic activity will pick up very, very quickly, particularly in the second half of the year. We might even get a 7 to 8% growth, I'm sorry. But on the other, that's right. But if it's bad, on the other hand, I mean, we'll be back to the 7.1% growth and a significant amount of distress. So I think it's safe at this point to get a 7.6, 7.7.
Okay. So we're back to being dependent on the rain gods. Rupa, but a quick question from your closing number. Will it be 7.2 or are you more optimistic, 7.8? Or will you again say it will depend on the rain gods?
Well, I, given the fact that, the present GDP calculation is marred with so many inconsistencies, rather than going in terms of exact number, I would say I don't expect FY17 growth to be any better than FY16, even if we get good monsoon, because agriculture has suffered from 4 consecutive cash negative crop cycles, and even if we get good rains this year, it's not going to result into any kind of a turnaround. And manufacturing slowdown has also become acute. So I would say that with good coordination between the government and RBI and growth supportive monetary and fiscal policies, we can at the best protect the growth of FY16 in FY17, but we cannot expect a better growth in FY17 at any cost.
Okay, spoken like a true economist, very cautious. But I'm afraid we run out of time completely. And much as I would like to continue this lively discussion, I'll have to call it to an end. Thank you so much, Saugata and Rupa, for joining me and sharing your views. Clearly, the governor has some very tough choices before him, especially now that the government has tossed the ball into his court. Markets have already factored in a 25 basis point cut in interest rates. Will Rajan do more and cut by 50 basis points? We'll know on Tuesday. Will it spur growth? Can the bank make up for lost time? Only time will tell. If not, it will add to the perception that the bank failed to read the downturn in the commodity cycle correctly and missed an opportunity to do its bit for growth. Thank you also for watching. Remember, we'll be back next week with yet another edition of Macros with Mythili. Till then, it's thank you and goodbye from all of us at DT Now.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.